Thanks, everyone, for staying this late in the afternoon. This is going to be a pretty exciting panel talking about stablecoins and the intersection of stablecoins and sustainability and how we can use stablecoin and stablecoin architecture to help fund sustainable activities. First, I'd just love for all the panelists to just do a brief introduction, who you are, what you're working on, and your connection to stablecoins and sustainability.
Sure, I'll start. Hi, everyone. My name's Anna Stone. I am one of the founding members of the Good Dollar Project, which is a crypto universal basic income project that's actually based upon giving out money to anyone in the world who wants to access it from a cell phone. We are one of the largest, most used projects in crypto. We have hundreds of thousands of users all over the world that are using Good Dollar, and stablecoins are a key part of how we give out more money for free. And so we've been using stablecoins for many, many years, and we've also done all sorts of integrations linking the distribution of good dollars for sustainable environmental actions. So excited to be here with you guys.
Awesome. I'm Boqdan. I'm the founder and CTO of Mento Labs. We are a platform for building stable tokens. We evolved inside of the Celo ecosystem. And kind of from the beginning, we tried to explore this intersection of sustainability and stable tokens. We had carbon credits in our reserve, I think, starting 3 years ago or something. And we focus on the long tail of local currencies, working a lot also in the UBI space with impact market and in the microfinance space. And we're also interested in how local community currencies can help shape sustainable behavior, and we're working on that side as well.
Hi, I'm James Glasscock. I'm the head of ecosystem at Reserve Protocol. Our project was founded to help people access sustainable inflation-resistant currency around the world. There's many countries where the price, the value of their local currency can change overnight almost. You might have heard of Reserve through the RPay project that's launched in Latin America. It was in 18 countries, places like Venezuela, Argentina. That's a centralized business that uses stablecoins. And then also the permissionless protocol, which is where I spend 100% of my time. The protocol allows anyone to create their own asset-backed stablecoins or flat coin or index products. Asset backing, revenue sharing, and over-collateralization are all programmable, and excited to talk more.
And I'm Luca Prosperi. I've been a nerd in stablecoin land for quite a while. I'm also one of the founders of a project called M0 Labs, and we just came out of stealth. We are trying to innovate stablecoin governance pretty much to get away from the world where we have 2-3 centralized issuers of stablecoins, sometimes building on top of banks. And why I think stablecoins are relevant here is money has always been the cheapest, the cheapest way of attracting leverage for asset holders. Now that gun is in the hands of governments, where they're pretty much funding themselves at very cheap rates. I think we can use it in a way more targeted and efficient way. So I think there are interesting overlaps we can talk about today.
And lastly, I'm Phil Fogel. I'm one of the co-founders and the chief blockchain officer at Flowcarbon. And for the past 2 years, we've been walking around talking about a vision. We're building the entire capital market stack for carbon on-chain that starts with the tokenized spot asset carbon credits, and then taking the project finance, bringing that on-chain, so the agreements between projects who create carbon credits and their delivery of carbon credits in the future in exchange for money up front. And then on top of that, building a securitization market on top of that, taking these relatively illiquid assets and trying to make them more liquid. And as we talked about earlier in the day, there's a need for trillions of dollars in annual inflows into carbon projects. And the only way that that's going to really work out is securitization. And an early conversation that I had with Luca a couple of years ago, back when he was at MakerDAO, was about how we could use and change the nature of the way stablecoins are created as you start putting more and more assets into them and opening them up. Where Maker, for example, started just with ETH, right? A lot of stablecoins now are talking about just dollars and treasuries. How do you open that up to things that are further up the credit stack? and make that so that we're changing the nature of what we back money with. But before we get too much into the weeds on sustainability and how we can use stablecoins to help that financial challenge of getting to trillions of dollars, I think it'd be good to just go around and actually talk about what are stablecoins, how are stablecoins created, what are sort of the different ways that stablecoins are created and used. You want to kick us off, Luca?
I can go on forever here. No, it's. I always joke that money is the most complicated mass-adopted product there is. People use it, and they really don't know how it is manufactured. They just think it's a payment product. Money is not payment product. Money is a leverage product. When you go to a bank and you ask for a mortgage, you think you're actually taking the money of some depositors and giving it to you. No way. They're minting that money out of thin air, and they're just giving it to you. Now, you can trust that that money is worth the value because that bank should be regulated as some sort of buffer, but sometimes it's not the case, and you realize it when that money you have in a bank account is not fully insured. So who has the printing machine? Who's making the real money here? Because they can finance themselves very cheap. You're a bank, you're a depositor, like whatever. They give you 1% to you, and they invest your money on an asset that yields more. Now, if the reason why Maker was very innovative, it was that actually they were really reinventing this model. So instead of having, like, very simple, you have Circle. You have a bank, you take money, you put it in a bank account, and Circle gives you a token. The leverage machine still stays with the bank. Circle is just giving you a derivative token that you can use for payment. What Maker was doing was very different. You were pledging an asset, originally ETH, and the protocol was minting money, which you were probably taking and buying more ETH and pledging more ETH. So you were levering up yourselves because actually the yield on the asset was lower than the cost you were paying Maker to mint DAI. I think this was a very exciting intuition because it says, okay, we have common rules, transparency, and actually we can create these very liquid instruments that can finance many assets underneath. In the time, ETH, wrap Bitcoins, and other stuff. At Maker, back in the day, we had this vision that Maker could have become the central bank of DeFi, could have absorbed many different types of assets. Now, the problem is you're opening the doors, and then everyone wants your money. And everyone's trying to bring the worst possible asset they can and get financed with DAI. So we had to spend a lot of time in thinking about rules and regulations to do that. Personally, I realized that there was probably not the right project to do it, and just so we moved on. But I think the intuition remained. I think you can have a very clear set of rules and structures that can allow many type of assets, from carbon, hard assets, digital assets, to come and be pledged and receive money in exchange that you can sell in the open market. And it's so solid that people use it, they don't care what's behind it. They just use it because they trust it. And I think this is a very, very powerful intuition that we can build on for the next decades.
Yeah, I mean, functionally what Tether and Circle are actually doing is they're just running credit funds and giving you a representation of that, and they're keeping the spread. And so there's an opportunity to sort of change that model and make that model more transparent to what people can do. And so, James, you're sort of building on that and saying, okay, well, anyone can build a stable coin, right? And how do you actually allow that to happen?
Yeah, it's always hard to follow Luca, but I think what's interesting about money and stablecoins is it's a language. A language, the U.S. dollar is, some would say, call it a meme, and it's one of the most well understood memes in the world, and it's been memeing now for a few hundred years, and we'll see what maybe kind of comes after that in due time. But as Luca kind of alluded to, there are all these assets that mostly today, a lot of the assets that are making up the asset backing for stablecoins are either treasuries or cash in a bank or other fiat stablecoins. But in the future, we might see rainforest assets, carbon assets, obviously. And these assets are already being tokenized. But a challenge for like protocols like ours is that you need liquidity depth of those assets, sufficient liquidity depth, so that people can get in and out of them really easily. We envision this world where you might have a stablecoin in the future. Most of the stablecoins today are just backed by a handful of assets or only one asset. But the thing that we're excited about is, what if there were a basket of 100 assets, right? And some of those could be decentralized. Kind of the textbook of it, when you have a basket of 100 assets coming from many different jurisdictions, is you start to get properties of decentralization for it. So that's how we think about it at Reserve.
I actually want to jump in because I love what you said about the US dollar being a language, because from my perspective, stablecoins have actually been the killer use case of crypto that's actually managed to secure mass adoption. And I think this is not something to be taken for granted. Actually, MakerDAO DAI is, I would say, the fundamental building block to DeFi. I mean, there was no DeFi without the decentralized DAI. No DeFi would have been created on the backs of USDC, especially during a period of time when the culture around decentralization was really full of zealots, if you will. And so I think that MakerDAO is actually one of the best examples in DAI of where crypto has really succeeded, and not just in terms of succeeding for the crypto industry, but also being the meme that actually reaches to people, right? So DAI is one of the most widely adopted cryptocurrencies in many areas of the world where they can't hold dollars, right? And again, this is not something to take for granted, because people in Argentina, for the most part, they're not swapping their paychecks into ETH or Bitcoin, they're swapping it into DAI. And so stablecoins are actually, and this is like, it might seem obvious now, like, of course, USDT and USDC have the largest market cap, but it's not something to be taken for granted. And the more proliferation we have in terms of what are the assets linked to, whether it's the US dollar or some other, or the euro, or whatever the representation is, and then also getting to play with the collateral set, which is what everyone's referring to, this is probably the most exciting, relevant area for mass adoption that we can talk about. And so I just wanted to share that.
Yeah, excellent, thank you. And Boqdan, Mento was born out of the Celo ecosystem, and one of the places that the concept came from the founding team was from a book called Sacred Economics. And one of the ideas that book talks about is that we back money with what we value most in the world, right? And it seems like today the US dollar is largely backed by warships, and that's what we as a society actually value the most. And you can think about that as a proof point. If the US was to start having to sell off assets, right? An aircraft carrier would probably be the last asset they'd sell off. They'd sell off Texas first, right? and so, how do you change the nature of what you back money with so that it actually changes the nature of what we intrinsically value, and moving that towards natural capital? And so I think Mento was founded specifically with that very mission in mind. Yeah,
that was part of our core tenet, and it's something we're still thinking about. Unfortunately, regulation is making this way more difficult. I mean, to one extent, we need deep liquidity for the reserve assets. We talked about that, we all know it. But also regulation that's coming now, it's trying to protect the consumer. So we're getting more constrained in what asset classes can actually back stable tokens. But this shouldn't really stop us from pushing the envelope further on this. And I've been having interesting conversations in the tokenized rainforest area. What if we actually try to tokenize forests that's meant for production, actually have paper, not like rainforests? Because that's actually a more liquid market, and we can actually retire that forest that's meant for production. So it's interesting for us, how can we find this intersection of natural assets that can back money, but that can still have some properties that we care about,
Yeah, I think one of the biggest challenges is, and this is one of the things that crypto is very good at solving, is how do you create liquidity for these assets? Because then, as James has talked about, you have an asset that's liquid, easy to slap some code on top of that and create a stable coin that lives on top of that. Anyone can do it. It's a relatively easy process. But where this gets more complicated is that actually a lot of the really deep natural capital assets are incredibly illiquid. And having a liquid market for them is going to be incredibly difficult to create. So you can create a liquid market for carbon credits. We've seen that that's doable on-chain, and that's easy. But carbon credits are not necessarily a great asset to actually back a stablecoin. They're meant to be used. They're meant to be retired. They have a price decay function that goes into them over time. They get less valuable because they're meant to be retired. But how can you actually take the necessary capital that's needed to develop carbon credits and using a credit market and actually start to put those inside of stablecoins?
I mean, I was actually thinking whether I agree with you or not that carbon credits are not the best, because actually they have a natural decaying function that partially solves the liquidity problem. I think you need someone that keeps replenishing the pool. But I think the reason why, and we had this conversation I think a week ago, one of the greatest inventions of modern monetary systems was the existence of a buyer of last resort, which was like a central bank. And the idea of having a black hole that is ultimately the absorber of last resort of carbon-related assets is actually a very powerful idea. Like that is actually the ultimate liquidity pool where you're going to go if the assets cover a certain standards, satisfy certain standards, you can go and pledge. But I also think that, and apologies if I get nerdy here, but I think carbon credit assets or carbon-related assets are great for stablecoins for a reason. They're very difficult to price. There is an incredibly beautiful paper on money markets that came out a few years ago, describes how the reason why money was successful, one of the reasons was successful, it was exactly the opposite of barter. I give you something, you give me something. We need to spend a lot of time trying to understand who is actually getting the best side of the trade. I need to price what you're giving me, and then it takes forever. The reason why money works is that it's so over-collateralized, it's so stable that I don't need to worry, what's behind it, because the price discovery is not important. The buffer on top is high enough so that it can absorb shocks, and I think it goes very well in connection with assets that are very difficult to price. Because you're saying, okay, it doesn't matter. There is so much of that this stuff is actually kind of backed. But you need liquidity for that. And I think creating liquidity out of retail market or atomistic market takes a long time. So I really think having an idea, we were just joking for it, but having some sort of like central carbon bank or central buyer of last resort for carbon-related assets, a very powerful one that can solve a lot.
Yeah, and that's obviously there's a vision and a dream, and there's another book, Ministry of the Future, that talks about carbon coin and actually doing that, where the central banks of the world basically put up that buyer of last resort. And I think that that's science fiction for a reason, because the idea that the governments of the world today are going to get together and do that is a little bit of a stretch. But I do think, and that's sort of where there's the beauty in the crypto landscape of doing some sort of experimentation that allows us to see how can that be done. And so I think if you were able to create a stablecoin that had hundreds of billions of dollars of liquidity against it, and then you started adding in and saying, okay, great, we're just going to start buying up carbon. And the buffer is so big that it's such a small slice of what you're doing that you don't care anymore.
I was just going to say that I think it actually really depends on where you start, right? Because what Boqdan is referring to, it's so radical. Like, I think we can't underappreciate how radical this idea of actually using natural asset-backed assets to back money, and then taking it the next step further of enabling communities themselves who custody and steward those assets to then to mint their own money on top of that. It really comes up a lot against all of our existing status quo norms, if you will. And so I think the question is, like, where do you actually start? What practically can you do in terms of addressing the liquidity issue, the trust issue, and then actually creating a model that slowly begins to insert some of these assets into the reserve to create the use case that creates the trust, that creates the belief, that creates the stories that people can begin to understand. It's all possible. right? But I think it's so radical that it's such a challenging problem to solve on so many levels that I think that's why probably all of us are like, we're going to do this for the next 25 years, right? It's because that's the timeline.
Yeah, I think two interesting examples of that too are just the US dollar and Bitcoin. They both have gone through that phase of storytelling and people believing in it, being able to use it in exchange, and obviously Bitcoin's a lot younger. But that sort of experimentation, and then of course there were many experiments before that, both here in both here in North America before the birth of the United States, and with Bitcoin specifically. It was just those two experiments are the ones that work, the ones we talk about. And I think one of the, I was kind of thinking about the carbon bank, wondering, I was sitting here thinking, I wonder if that'll be a centralized institutional driven effort, or if some folks, maybe in the DeFi community might get together and build something that's probably looks a little weird to a lot of people until it doesn't. It's actually a really exciting idea. I hope it does come from DeFi.
Yeah, just thinking through some of the innovations that are taking place in stablecoins and thinking through sort of what M0 is launching. And you guys put out your white paper a few weeks ago, and what you're starting with is just the most boring, basic, safest assets that you can possibly have. People can come with treasuries and mint a stablecoin essentially against it. How do you go from that, which is very simple, very basic, everyone sort of understands it, to going up the curve to riskier assets and to eventually getting to an asset like carbon?
I think you need a lot of time, because I think there is, as a builder also, if we go back to the point that stable coins or money in general is for the user a convenience product, and for the printer a leverage product, you need to understand who are you optimizing for. I think until now, unfortunately, we have been optimizing for the leverage. So a lot of issuers have been saying, okay, there are these people that are buying this thing one-to-one. They have no clue what I'm doing with the money behind it, and I'm gonna make a lot of money. So if you take a lot of issuers, they have tens of billions of dollars. I mean, some issuers, one issuer has tens of billions of dollars of stable. You don't really know what's at the bottom of the stack because you're never going to get there. And also, so not all the projects have been optimizing for the other side, which is the convenience. I think that we have been trying to create something that really is very, very careful in protecting the key characteristics of money, which is convenience. You can trust it, is storage of value for the very long term, not necessarily stability, pricing stability in the short term. I think this is a local optimization point. So we start from treasuries. So that is not coincidence that we haven't called. So we start from treasuries, but we think this is a moving target. It's not coincidence that we decided to call our, let's say, output stablecoin M and not USD something. Because we think it's raw material for something else. We think the stability is actually an extra functionality that is actually non-core. And we also think that, to your point, today is dollar because we are thinking in dollar, but maybe in 10, 20 years' time, it's going to be something else. So for us, it's raw material that keeps evolving. But we start from treasuries because it's the easiest asset. There is no inherent credit asset if you're thinking in dollars. There is no limited counterparty risk. It's very liquid. And there is yield today. But this thing will evolve. So to be more practical, I think that I'm truly expecting the collateral eligibility criteria of an M0 or a project like M0 to evolve in the same way central banking eligibility criteria should evolve. So at the end, with time, certain assets should be absorbed in the collateral basket in a very conservative way. I'm expecting to see Bitcoin having 5% of the underlying collateral pool way earlier than short-term credit in Latin America, and I live in Latin America, so I know these markets because it's very difficult to price. So I think it's going to take some time, But unfortunately, if you're creating something, as long as we're thinking in dollars, we are always going to be over-indexing on dollar-denominated assets. So as long as our stable coins are dollar-pegged, the assets that they're going to compose the vast majority of it are going to be dollar-denominated assets. So most probably treasuries or treasury-like products. So it's going to take a lot of time. But I think in 20 years' time, 30 years' time, we are not even going to index probably on dollar. It's going to be a different basket or different currencies that live around it. So I think the two sides of the stablecoin printing machine will evolve.
Just as a fun thought experiment, if Bitcoin continues to take off the way it seems to be this week, and we eventually end up in a world where Bitcoin is a very dominant part of the global monetary system, how does the system adapt to starting to print money on top of Bitcoin and to basically do a decentralized fractional reserve system, or can it not handle that?
No, I think it can. It's simply, in our case, for example, governance would, because in our case, validators minters need to provide an on-chain proof of reserving. And by the way, we're creating off-chain instruments to do all this, but we're just not advertising it yet. So minters that need to provide an on-chain proof of reserve, and validators need to co-sign it, let's say. So these reserves need to be compliant with a certain set of eligibility criteria. So if 5% of the underlying, we're making thought experiments, 5% of the underlying collateral pool can be Bitcoin. Simply, it's an approved collateral. You can create fractional reserving on top of it. But I think the problem of Bitcoin is not the price. The problem of Bitcoin is the volatility against the dollar. But I wouldn't be surprised that in parallel, like some central banks will start adopting, Bitcoin as an approved collateral for their discount window, maybe 0.5% or something like that.
I think this is why what Reserve and what Mento are doing is actually so critical and so interesting, is because I think now the acceptance is going to come that cryptocurrencies like Bitcoin or Ethereum or others, large market cap tokens, make sense to hold as collateral. But the problem is actually the volatility, which is what keeps normal people from wanting to spend it like money, right? And so the holy grail is actually these flat coin innovations, if you will, that will enable a mix of collateral, of which dollars is just one of them, and you get the benefit of having a multi-asset reserve that's not just exposed to the price of the dollar, but actually then functions in a way that's not volatile, so you're not the person who spent 10,000 Bitcoin on pizza.
Yeah, that's true. And what you mentioned, right now our stables are backed by Bitcoin, Ethereum, a lot of USDC and DAI to make people hold, but it becomes a problem of how you do risk management on your portfolio essentially. And in that world, with things balloon, like we saw that in the last bull market, our exposure to Bitcoin was way more. And as the market went down, we exposed to stables so that we can ensure stability of the system. Yeah.
Yeah, I mean, the other thing that's really interesting to talk about is the regulatory side of this and what you can use to back a stablecoin. So, for example, Adam earlier was talking about creating assets on chain that are backed by very high yielding assets that are backed by, really high quality assets that have relatively low loss rates. And if you create a pool of these assets, you can do them, but they're securities and they're very fundamentally security assets. And, to date, that's been a stumbling block to getting those sorts of assets inside of stablecoins. How do we overcome that? How do we push that forward and say that's not an issue, that shouldn't be an issue, especially when the majority of stablecoins today are actually backed by securities off-chain. They're just not backed by securities on-chain, those being treasury bonds and the like.
Yeah, there's kind of this divide happening where a number of these assets are being created and distributed on a permissionless basis and some on a permissioned basis. And, time will tell exactly how that will play out. Right now, like Reserve Protocol, we call these asset-backed currencies our tokens. We don't create them, though. It's just a platform for anyone in this room to use however they want. So you can create things that are backed by fiat stablecoins. You can use some of the products like from Ondo or Backed Finance to go into the basket. One of the challenges, from kind of our perspective is people being able to get in and out of assets on a permissionless basis. We already kind of talked about liquidity depth challenges for these assets. When they also have restrictions around permissionless access, it doesn't make it a very good collateral for a permissionless platform. But it could be a great collateral for a specific use case, something that might live in a walled garden. How does it play out? Well, we do think if people created R tokens that were backed by securities, then they're probably securities. Encourage people who are using the platform to follow the laws in their jurisdiction. I'm sorry I don't have a more sophisticated answer than that, but there's a lot we don't really know about how it's going to play out, but we're hoping to see more permissionless assets be accessible. And some of y'all might have seen, there's several of these assets that are being only issued on a permissioned basis, but they're trading in curve pools, they're trading on DEXs, and anyone can access them. And that's all a current kind of work in progress with those projects that are also trying to be compliant with whatever jurisdiction they are issuing from.
Yeah, so I will put a lot of disclaimers here before I say what I'm going to say, but personal opinion, don't represent the project, etc. But I think we need to be very intellectually honest and admit that the regulators in incumbent financial markets, they're not our friends. When we talk about stable coins, who owns a printing machine is making a lot of money. So commercial banks have lost the underwriting battle. Most of the higher yielding, more sophisticated assets are not underwritten by the commercial banks. Our hedge funds are making the money. Commercial banks have the monopoly on deposits. They don't want to let it go. And they will lobby until they die for that. And the regulators, they are partially in good faith because they want to protect the consumer, but partially not, right? I mean, there are a lot of conversation about security, but then you can gamble your life. You enter in a casino, you just sell your house, and it's fine. Probably you can get a credit line in the same room. So I think that it's challenging. I think what I say also we say like at M0, and this is, we say it all the time, is that, at least I say it all the time, is that we should be very proud of what we're building if we are asked to defend it, independently on regulations or not, regulatory arbitrage, etc. Now, the positive side of it is that synthetic, unregulated money already exists. The euro-dollar market is probably a $10 to $20 billion market, $1 trillion market that has been around for a long time. And actually offshore is where dollar-denominated assets are needed, right? Like we talk about Latin America, for example, or any type of alternative currency is needed where there is not a strong regulatory framework that protects the consumer. So we have space to innovate, but I think we need to be professionals, operate in good faith, but also be able to swallow a certain amount of risk, because regulators are not our friends. Sometimes in good faith, sometimes in bad faith. But this is a war for the ultimate profit center, which is deposit taking and financial intermediations. So it's going to be a hard one to fight.
Here. Just want to, before we wrap up, open it up to any questions from the audience. I saw a hand go up a couple of minutes ago.
I wanted to ask you about how you're thinking about governance for stablecoins, because you guys are doing, Luca in particular, you guys are doing something really different. And you have several tokens, and it kind of looks like a VE model. I'm just really interested in how you thought about that design, and why do you think that's better to govern a stable coin?
Yeah, very, very quickly, because we could talk about this forever, but I think good monetary system ultimately are systems that have good governance. Good monetary systems typically have independent central banks for the governor. Otherwise, nobody's buying the Argentinian peso these days, right? For good reasons. I think that, so we spent a lot of time on governance, and now the reason why if you go on our white paper, we designed governance the way we designed it, is that we think that governance should first of all be focus on doing very simple things. So in our case, governance does permissions actors that can come and interact into the system, so kind of protects the boundaries of the system. I'm not a believer in very distributed monetary policy in DAOs like Maker. I've seen how these things get very political. So I think our governance will resemble more an on-chain consortium. The reason why we split the tokens, as you mentioned, is we are splitting voting, controlling abilities, and economic rights, because I think in the same way in the shareholders economy happens, you have the ability to actually control the key decisions, but not necessarily the same people are the right people that want to get the economic benefit. If I am like a very large fund, I want to back this project because there are money to be made, but I'm not the best person who can vote. I don't want to get the liability for it. And what you say when you refer to the VE model is not a technical VE model, but it's an inflating model, because actually we want to avoid capture. So if some, we have seen in DAOs how like 3-4% of the token float can decide the whole governance. We have a system where if you are not participating in voting, we are not going to capture your economic rights, but we will dilute out your control of the system. And so the system will progressively auction out governance tokens to bidders. So we spent a lot of time. I think Greg, one of the three co-founders, is not here, but Greg spent a lot of time thinking about governance. Because ultimately, if you don't have a solid governance, no monetary system is going to work.
Yeah, very cool. Thank you.
Yeah, really great panel. Really awesome insights and thoughts. Anna, good to see the progress you've made at Good Dollar the last couple of years. With interest rates higher, it's obviously easier for you to pass on more money and have more money coming in. Can you give any thoughts to what you would do and you and Glow Dollar if interest rates go down and you're not getting the yield from, say, U.S. Treasuries you are now?
Yeah, it's a great question, and it's a great example of where programmable money actually has an ability for its features to shine, right? One of the interesting things about the Good Dollar model is that we hold stable coins in the reserve, but you can always add or reduce leverage to a reserve, right? The other element behind that is ideally, you're operating in an environment when yield is low on dollars, maybe Ethereum is higher, right? And that's where multi-asset reserves actually become really interesting, is that you can put, multiple financial instruments into your reserve, and then you can also modify the rate of leverage based off of the activity that you see happening in your own little microeconomy. So that's actually a great example of how stablecoins are fundamental primitives, financial primitives, upon which all new sorts of community currency innovation can be based. I hope that answers it.
Cool, thank you. Thank you, Rob. Phil, it's obviously you spent a lot of time thinking about the end of the dollar. I think about this a lot myself, and I'm curious if you think, if hyperinflation continues in the U.S., do you think anything else will lead to Bitcoin being the global currency? Do you see something else that would maybe accelerate that or deaccelerate that potential process?
So I don't know that we're quite at hyperinflation in the U.S., but I think that the point that actually is really relevant here is if you look at the all-time highs in Bitcoin in other currencies, right, you're starting to see a lot of major currencies make all-time high. I think the British pound today made an all-time high in Bitcoin. Yen made an all-time high a couple of weeks ago. And so, we don't experience this because the dollar is strong and dollar supremacy, so we don't think about it in terms of, like hyperinflation and what happens against that. But so Bitcoin supremacy is starting to show itself as a store of value against other currencies, not just against the Argentinian peso, which was always the example that was held up of people in Argentina really need Bitcoin. Guess what? They need it in Japan also, it turns out. Yeah. And so that's what's going to happen over time. You don't want Bitcoin to succeed because of an event or a black swan event where you have hyperinflation in the United States, and so Bitcoin is the only asset that people are literally willing to transact with. That would be a disaster. Our lives would be massively disrupted if that happens. You want sort of this steady, slow state adoption of Bitcoin, which is happening. You're seeing it. It almost is acting like a natural system. I don't know if anyone follows like the power law theories on Bitcoin, but it's almost acting in the way that natural like cities grow, and the way that cities grow, and the way that planets interact with each other. Like Bitcoin is just taking off in that direction, and a lot of the adoption that's coming with it is a function of that, of the natural system taking place. And so the idea that we're talking about backing money, right, stablecoins with 5% Bitcoin, that's going to that's a crypto thing. That's a very natural thing for us. But you can see where that's going to evolve outside of just crypto in the mainstream, and that's going to start becoming more and more prevalent. I don't know if anyone else has other thoughts.
Yeah, it's going to take forever. I mean, I think that that's like a healthier perspective to have than probably where a lot of people started, which is like we actually thought we were leading a financial revolution. Like, spoiler alert, that's not happening. Like, it's a long slog. So I think that you can actually
still a revolution.
but still a revolution.
Yeah.
But I actually think you can take solace in that.
Come for the party, stay for the revolution. Which, speaking of which, we're over time, and there are drinks upstairs and next door, which everyone is hopefully going to come and have some drinks and ask some more questions of everyone. Thank you to
Thank you.
And thank you to all of you for coming today.
Thank you.